Hi guys, welcome to FinBank Academy. Today we are going to discuss one of the important topic in BFM Module 1, that is exchange rates and forex business. This is very important for CIB Module 1. I think in the last June 2025 there are around 4 to 5 questions from this chapter only, and only numericals only, that also only numericals. So you should remember, this is the one of the important topic to clear the CIB BFM, and usually you will get 4 to 5 questions, 4 to 5 marks. Got it? And one more thing is that this chapter is not bit difficult and not bit confusing also. Very basic chapter and very easy chapter, but you should familiar with the exchange rates mechanism, and you should know what is buying rate, what is selling rate, and what is offer rate, what is bid rate, and what is spot rate. The basic terms you should know, right? Okay, let us start our class. What is the objective in this class? The basic details of foreign exchange rate mechanism, and we will end up with numericals. And there is a concept called derivatives product in this chapter in this chapter, but we are skipping this chapter for the next video. Got it? So we are all know forex. We all listen about the forex. We are all hear about the foreign exchange. What is the basic definition of foreign exchange? As per the FEMA Act, we are all familiar with FEMA in 2000. What is the FEMA? FEMA means Foreign Exchange Management Act. Earlier there is a FERA, Foreign Exchange Regulation Act, right? Okay, but as per the FEMA Act, what is the definition of foreign exchange? All deposits, credits and balance payable in foreign currency. Any drafts, traveler checks, letter of credit, bill of exchange expressed in dollar in Indian currency and payable in foreign currency. This is the definition as per FEMA. But in simple term, no need to remember this definition. Nobody will ask the definition. But in simple term, what is foreign exchange? Foreign exchange means what? It is a contract. It is a contract to exchange funds in one currency to another currency. Got it? It is a contract to exchange funds in one currency to another currency. That is foreign exchange, right? And who are the players in the foreign exchange market? Foreign exchange market is a very vast market, and number of players are there, and it's a 24/7 market. Got it? But who are the majority players? Who are the major players? The first and foremost is central banks, because these are the regulator for foreign exchange, and commercial banks, because these are the main key role players in the foreign exchange markets, because many operations are done by the commercial banks only. And investment funds, large corporations, forex brokers, and lastly individuals. These are the major players in the foreign exchange market, right? And what is the characteristics are what are the characteristics of forex market? The first and foremost is, it is a dynamic and round the clock market. We all know, because different time zones the foreign exchange market will apply. Suppose in the Japan it is a morning, but for us it may be night, right? For us, if it is a morning, for US and other western countries it may be the night. So due to different time zones, the foreign exchange market will work 24/7. Got it? And one more thing, it's a global market with no barriers and no specific location, and also it's a highly liquid market, and it's high fluctuations in current rates. So this is the main thing, because it's all depends upon the exchange rates, right? Exchange rates are fluctuates very heavily, and minute to minute, even the second to second also, sometimes the exchange rates fluctuates. And settlements affects by time zone, that I discussed now. The time zone is matters here, because if we done in the morning, for America it may be the night. So if we done in the office hours, it will reflect in the America in the office hours. The office hours may be next day for them. Got it? Next, what are the factors determining the exchange rate? This is the important. This is also important for the examinations. What are the factors determining the exchange rates? The first and foremost is BOP. BOP is what? Balance of payment. This is the economical term we heard in the economics only. Balance of payment is nothing but what? This is the difference between current account and capital account. Current account and capital account, simple in simple term, it's a difference between imports and export. Got it? If balance of payment is surplus, means if our exports are high, then what will happen? Our home currency will increase. Surplus leads to stronger home currency. In case balance of payment is negative, what will happen? It's a reverse scenario. Our home currency is devalued and foreign currency will be higher. Got it? And second thing is fiscal policy. Fiscal policy is what? It is a, in simple term, it's a budget or a policy by central government. Expansionary policy, we all call it expansionary policy or contrast policy. Means what? Deciding the rates of taxation. Got it? If there is a low tax, what will happen? Low tax, what will happen? Growth may be increased. If growth may be increased, what will happen? Home currency increased. Got it? If there is high tax, the reverse scenario will be happen. And monetary policy. Monetary policy means what? It is decided by RBI and it is deciding the rates, interest rate. Interest rate will always depends upon the exchange rate, which always affect the exchange rates. And I all discuss interest rates. And political issue. This is the major determining factor for exchange rates. If the political power or political party is unstable in any country, definitely there is high volatile in the exchange rates. Got it? These are the major factors which determine the exchange rates. Next, also there is a technical reasons. What is the technical reasons? If there is a suppose if there is a high restrictions in the foreign exchange or high restrictions in capital market, what will happen? It affects the exchange rates. If there is high restrictions and nobody is interested to invest in that country, then automatically their home currency's value is diminishing. Got it? If there is high freedom, means lot of foreign exchange will be there in that country. So that is also a negative impact. So depends upon the freedom and restriction of capital, there is high impact on exchange rates. And speculations. These are the biggest players in the foreign exchange markets. Somebody do the speculations, means suppose US dollar will go to this much amount and euros will go to this much amount, and they will start the trading on the speculations. And this is also affect the exchange market, right? And there are the types of exchange rate mechanism, and there are the types of rates. These rates are very much important for our examinations. Up to now, what we have studied here, this is the basic for foreign exchange. Means what is foreign exchange, what are the market, what are the exchange rate determinants factors, and what are the characteristic foreign exchange market. Up to this is the basic. But from now, this is important for our examinations. And these four, 1, 2, 3, 4, these four are very much important and very much basics for your numericals. Got it? Okay. What is the first type of rate? That is ready or cash rate. Suppose you went to a bank and you purchased US dollars, around US dollars 1000 you purchased. Got it? And you have given your INR, and they have given US dollars in the same day. Then that rate we call it as ready or cash rate. Means settlements of funds takes place on the same day. Tom means tomorrow. If they have given the US dollars tomorrow, then we call it as Tom rate. Means settlements of funds takes place on the next working day. And spot, this is the major rate. Majority people use this rate only in the forex market. What is this? Day after tomorrow. If they have given that US dollars day after tomorrow, then we call it as spot rate. Also, settlements of funds takes place on the next working day, on second working day, not next working, second working day. Got it? And due to vastness of market operations in different time zones, most of the forex deals on spot basis only. I already told you there are different time zones. Due to the time zones, the majority people use the spot rate. And even we have seen in numericals also, The majority questions are based on spot rate only. Very less questions are from term rate or ready cash rate. And forward means what? Any calendar day. Suppose they have in our previous example, we said that we have given US dollars 1000. We have requested for US dollars 1000. They said that we will deliver you US dollars on 30th September. That may be forward rate. Whatever date beyond the spot rate is called forward rate. Means settlements of funds takes place on any date after spot date. I have taken one example here. See, Bank A bought US dollars 1000 against INR from Bank B at the rate so and so rate. So ready rate means what? Suppose the date is 24/8 2025. So ready rate means the same day itself, term rate means the next day itself, spot rate means the second day, second working day, 24 to second working day, 26. Forward rate means any day after spot rate. Got it? And next, there is one more concept called forward premium and forward discount. Means if we are agreed for a forward rate and there is a high exchange rate on the market, because market rate is very high. For example, you have requested for US dollar and your US dollar value is increasing day by day. Got it? So the seller maybe charge the premium amount. Premium amount is nothing but if you see in the retail loans or MSME loans, there is a term called spread rate. It's all depends upon the risk, right? Suppose if you have one loan, you went for loan and they will say that UBLR plus spread rate 2.5, that is interest rate. So many managers will usually told to us EBLR plus this 2.5. This 2.5 is called what? Spread rate. Like that, there is a concept called premium and discount. Got it? Premium means exchange rate, that is spot rate plus additional amount. Discount means spot rate minus some additional amount. Got it? What is premium? Premium means forward value of a currency higher than the spot value. They will add some value and they will sell to you. The added value is known as premium. Or else, if there is a negative sense in the currency, or it is a day by day, the value is diminishing, they may give some discount on that spot rate. That we call it as a discount. Got it? Similarly, the forward value of currency cheaper than the spot value. Higher than the spot value is known as premium. Cheaper than the spot value is known as discount. Got it? And there is very most important term is direct and indirect quotations. This is the important term and we should know it. What is direct and indirect quotations? I already told you I am purchasing US dollars. Then how we will describe it is 1 US dollar is equal to 75.41 INR. Let's suppose we call it as a direct quote, right? What is direct quote? Direct quote is nothing but what? In the direct quote, the foreign currency is stable. Foreign currency is stable. Home currency is varies. Means one foreign currency is equal to how many units of home currency? One foreign currency is equal to so many units of home currency is called as direct quote. Like this is the example. 1 US dollar is equal to 75.41 INR. It may be varies. For tomorrow it may be 1 US dollar is equal to 76.42 INR. Day after tomorrow it may be varies. Like that. In the case of indirect quote, what will happen? Home currency is constant, foreign currency is variable. So home currency is equal to so many units of foreign currency. This is what indirect quote. In direct quote, left side is foreign currency. In direct quote, left side is home currency. Just remember blind thing. 1 USD is equal to how many INR is called as direct quote. 1 INR is equal to how many USD is called indirect quote. Got it? See, this is the example. 100 rupees is equal to this much USDs. This is indirect quote. Generally, we use direct quote only. And there is also one mechanism, cross rate mechanism. What is cross rate mechanism? Suppose some currencies are direct conversion is not available. Suppose GBP by INR is not available. Then what we will do? We will use some other currencies like USD to calculate the GBP by INR. Got it? Like that. See, we need to quote GBP against INR. That's I already taken an example. However, since India usually GBP is not quoted directly, so we will use USD to compute the GBP by INR. That cross rate mechanism. Got it? And very most important is bid rate and offer rate, buying rate and selling rate. This is the most important. This is the thing where people usually confuse about the numericals. Got it? They have given in the example like this, USD by INR is equal to something. Got it? In this is what this meaning is. USD by INR is equal to 74.95 by 74.96. This is called what? Buying rate. Also called bid rate. And this one is called what? Selling rate. Also called offer rate. Got it? Buying rate, selling rate in prospective of what? In prospective of financial entity or bank, not in prospective of customer. Just remember this thing, very important. Buying rate and selling rate in the prospective of bank only, not in the prospective of customer. The buying rate of a bank is equal to selling rate of a customer. The selling rate of a bank is equal to buying rate of a customer. Suppose in that numericals there is in the numerical they have mentioned like this. What does that mean? The bank is going to purchase US dollars for a rupees of 74.95 INR. So 1 US dollar cost is 74.95 and bank is going to sell this USD for 74.96. Bank always sells it higher because they are bearing exchange rate risk. Got it? And also this is called bid rate. This is called offer rate. Bid rate is nothing but what? The bank is going to bidding. Offer rate is nothing but bank is giving you offer. If you are clear this one, then only we can understand the numericals. Got it? What is bid rate and what is offer rate? What is buying rate and what is buying rate and bid rate is same. Offer rate and selling rate is same. This buying rate and selling rate is in the prospect of bank only, not in the prospect of customer. And bank buying rate is equal to customer selling rate. Bank buying rate is equal to customer selling rate. Bank selling rate is equal to customer buying rate. Got it? And there is a concept called inward remittance and outward remittance. This is also one of the important. Inward remittance is what? Foreign inward remittance. Bank receives, for example, bank receive inward remittance in foreign currency. Suppose some NRI is staying in US or suppose our relative is staying in USA. Got it? He is sending money to our account. That is inward remittance. Inward remittance means what? Foreign currency in. That is what inward remittance. Outward remittance is what? Foreign currency out. Bas. Foreign currency in is also called purchase transaction. While purchasing also what will happen? Foreign currency in. While selling or remitting, what will happen? Foreign currency out. Got it? So inward remittance means foreign currency to home currency, and outward remittance means home currency to foreign currency. Just got it? And then we got it to the numericals. If you don't confuse about the numericals, it seems very lengthy, but these are very simple if you understand the concept well. See, that's the first example. Calculate the rate of inward and outward value, assuming the spot and margin of 10 paisa. One more important here, this what is margin. You oftenly see the margin and premium in your numericals. When we add the margin, when we less the margin, that you must know. is buying your foreign currency, when bank is buying foreign currency, then they will deduct margin. When bank is selling foreign currency, they will add the margin. Got it? Margin is deducted for buying rate, added to selling rate. Remember, when we add it while selling, only I'm talking only in respect of bank only. Don't confuse. Only I'm talking about only in respect of bank only, not in respect of individuals. Where never I mention about individual. I only mention about the bank only. When bank is buying foreign currency, then we deduct margin. When bank is selling foreign currency, then we add it to the margin. Got it? See, they have given the rate, spot rate, what is called USD by another. This is the spot, and this is the buying rate, and this is the selling rate. Inward remittance. Inward remittance means what? Buying rate. We are purchasing. Foreign currency inflow means purchasing. That is buying rate. This is the buying rate. Buying rate may, in buying rate, what we have to do? Margin. They have given the margin. Margin is of what? 10 paisa. 10 paisa buying rate. What in buying rate? What we have to do? We have to minus the 10 paisa. So 75.005 minus 0.10. The value is 74.90. They have asked that only. And outward remittance value. Outward remittance means what? It is nothing but what? Selling transactions, like that. So we consider the selling rate. Selling rate. We consider selling rate. Selling rate is what? 75.0075. And we will add this margin. Margin 0. How much? 0.10. What is the final value? 75.1075. This is the outward remittance value. The basic, just the basic. We haven't done anything. Whatever they have given in the problem, we have mentioned that only. Just we have added margin and deducted the margin. Got it? And the next sum. See, for retirement of import bill for GBP 1000 rupees. GBP is not 1000. It's a 1 million. By TT margin. What is TT? TT is nothing but what? Telegraphic transfer. Okay, I will explain later. TT margin 0.20. Ignore cash discounts or premium. GBP by USD is equal to this much rate. USD by INR this much rate. Compute GBP by INR for customer. Okay. First and foremost, we have to return what is the input value it has given. Input value. What is the input value? Margin. How much he has given? 0.20%. Next, GBP by USD, he has given that rate. How much he has given? 1.2175 by 85. And USD by INR he has given. That is, these are the input values, right? 75.4770 by 4870. Okay. What we want? That is our output. What we want? GBP by INR we want. And we have discussed earlier, GBP by INR, there is direct quote not available. We have to use the cross rate mechanism. Suppose in our 10th class or plus 2 level, if they has given A by B and B by C, we need to find A by C. What we will do? A by B into B by C we will do, right? Then automatically our A by C will come. The same thing happen here. He has given what? GBP by USD, and he has given what? USD by INR. So GBP by USD into USD by INR. So that we will get it as GBP by INR. Right? Okay. Now there will be confusion. Which rate we need to consider now? Means buying rate or selling rate. That is the most important thing. Which rate we need to consider? In that question, he has asked that retirement of import bill. What is meant by retirement of import bill? Retirement of import bill is what? It's nothing but a bill of exchange. Suppose a exporter or a customer, he purchased some goods or services from foreign currency. Means from abroad person, from overseas person. He sent the goods. And he also sent a bill to the bank. This much amount he has to pay. Means the exporter sent a bill, that is GBP 1 million has to pay by the customer. Means this customer, Indian customer, remit the GBP to that overseas customer. Means Indian customer need to purchase GBP. The GBP is what? Great Britain pound. Indian customer needs GBP. Means he has to purchase GBP. What he is having? He is having INR. Got it? He is having INR. So bank, what the bank will do? Bank first will do what is having INR. Bank used to purchase USD with the INR. Bank used to purchase USD, and with the USD bank will purchase GBP. Right? So bank is purchasing USD. Bank is purchasing GBP. Means bank is buying. Bank is buying means what? Customer is selling. Bank buying rate is equal to customer selling rate. Right? What bank rate will decide? Bank is always decide the selling rate. That is the higher rate only decides. What it? We consider here higher rate only. That is bank selling rate. Bank is purchasing and selling to the customer. Got it? Bank is purchasing these currencies and selling to the customer. So bank will consider what? Selling rate. That is, our selling rate is what? GBP by USD case, what is selling rate? 1.2185 into USD INR in the what is selling rate? 75.4870. What is the value? This value is equal to around 91.9809 if we calculate. Got it? This is the what? GBP INR. But he has also given one margin 0.20. What we have to do? We are selling. Bank is selling. Bank is selling means margin should be added. What is 20% margin? It's a plus of 20% margin. The 20% margin of the 20% of 91.980 is nothing but what? 0.1839 if you calculate it. The final answer is what? 92.1648. This is our final value. Got it? I will revise once more. He has given GBP by USD. He has given USD by INR. We need GBP by INR. So we need GBP by INR means we need GBP. What we are having? We are having INR. So what we are having with the INR, the bank is to purchase USD. Then with the USD, the bank is purchased to GBP. So when bank is purchasing, the bank always offers offer rate only. That is selling rate only to the customer. So we will consider the selling rate. This is the selling rate, and also this is the selling rate. We will multiply these two, and we will get the answer. And further 20% margin will be added. That is the final answer. Got it? And we will go to the next sum. See, on 1st June, a customer requests a book forward contract. What is forward contract? Forward contract means the two parties will decide to fix a rate. Suppose me and my friend go to the forward contract, and we both are fixing a US dollar rate, that is something $1 equals 74.94, and I will give this amount on 30th September, but the rate is today's rate only. That is nothing but a forward contract. So on 1st June, a customer requested a book forward contract for retirement of import bill. That is, I explained here, retirement of import bill is nothing but it's simply bill of exchange. Import bill of US dollar 1 lakh, due for payment on 15th September. Important. Given this USD by INR, this is the input value, and forward premium. Premium means always plus. Spot June month this month, July month this month, August month this month, and September month this month, and August to 15 September this much. Margin is 0.2%. Got it? Now, what we want it? We want a rate. Just we need a rate. Actually the due for payment is 15 September. He need how much money he has to pay in INR rupees. That is our question, right? Is some seems very complex, but nothing is there in the problem. There is nothing. Just we remember, we need to consider what is the input value USD by INR that he has given. What is that? 75.27 by 29, and he has booked on 1st June and his due date is 15 September. Got it? So the premium we need to calculate. For example, let's say example, one customer has taken the gold loan on 1st June and he came on 15th September and he asked to close my gold loan. So you are in the counter, you are going to calculate the interest. How we will calculate? First we will calculate 1st to August and September 1st to September 15th, right? In this mechanism only the premium also calculates. Got it? He has the bill due date is 15th September. So the premium we calculate for 1st June to August and September 1st to September 15th. This is the premium we consider. Get it? Here he has given the forward premium spot June for June month this month, July month this month, August this month and September this month. We don't want June, July, September because we need only August only. At the ending, actually this is the ending, 1st June to August, this is the ending, right? June, July we don't want. We should ignore those things. So what is the August premium rate? 32 by 34 means 32 paisa by 34 paisa. And also there is 15 days in September, right? In the September he has also given August to 15th September, that is 6 by 7. This is the premium rate. Got it? So in the USD INR, what we will consider? Whether we buying rate or selling rate. It is for import bill of US dollar 1 lakh, right? We have to give US dollar. We have to give US dollars means the bank is going to sell the dollar. So we will consider the bank selling rate only. Got it? We will consider the bank selling rate. What is bank selling rate here? 75.29, and there is a premium. Premium is what? This is up to August 0.34, and in the meanwhile the September dates, that is 0.7. If we add all these, we will get what? 29 4 plus 9 41 paisa plus 75.29 plus 41 paisa, 75.29 plus 0.41, that is 75.70. Got it? 75.70. And there is a margin he has given 0.20. The margin is bank is selling. Bank is selling means what? Margin should be added or minus? Added, plus 0.20 percentage of 75.20. This is the value of what? This is around 0.15. So 0.15 plus 75.70. The final figure is 75.85, right? 75.85. This is our final answer. This is the rate the bank is going to quote to the customer, 75.85. Got it? See, the sum seems very complex, but nothing is there. What is that? USD by INR. On that USD by INR, what we have to consider, that is important. Whenever there is a US dollars, means bank is going to sell the US dollars to the customer. So bank selling means always bank selling rate we consider. And he has given all the months of premium. We no need to consider. We consider the ending month only. Ending month is September, but September 15 days only. So what is the previous month? The previous month August. So we will consider only August month premium rate. And September, in the September 15 days also he has given that rate, that is 6 by 7 paisa. So all the premiums also we will consider the selling rate only, because bank is going to sell that US dollars. Got it? Simple. Next, numericals. This is a bit interesting also. So some Mr. XYZ wants to remit JPY 100 million by TT. TT means what? Telegraphic transfer. Telegraphic transfer means what? He has to remit this amount into Nastro account. Have you heard about Nastro account? Nastro account is means what? Suppose our SBI is there, or else any domestic, public sector bank is there. They will maintain foreign currency account in foreign banks like Bank of America. They will maintain on foreign currency account. That account is known as Nostro account. Okay. So Mr. XYZ wants to remit Japanese yen of 100 millions by TT spot rate, on spot basis. He has given just what is the input value, USD by INR he has given, USD by Japanese he has given, and also add margin 0.5%. Calculate the quote. Quote we need to calculate. Similar problem we have solved in earlier. He has given GBP. There we asked GBP by INR. He has given USD by INR, I think. Also he has given what they have given. GB by USD given, USD by INR given. He asked GB by INR. But here, see, I also take one example there. That your 10th class mathematics. Given A by B, B by C, we need A by C. So we will do A by B. Wait, I will write here. A by B, B by C, and we need to find A by C. So we will multiply it. But if he has given A by B and A by C, what we will do? In our schooling, what we will do? We will do A by B by A by C. Right? We will make division, not multiplication. So it will automatically become A by B into C by A. So we will get C by B. It will be reciprocal also. Same way, here also what he has given, see, here also what he has given USD by INR, USD by Japanese. What we want? We want JPY by INR. We want JPY by INR. Got it? JPY by INR we need. It's like a similar example. It is like a previous example, but little bit difference is there. Here also same. The customer needs Japanese yen, is having INR. With the INR we need to purchase USD. With the USD we need to purchase JPY. So we will consider the selling rate only. The first step. There are the two steps here. First step we will purchase the USD. Second step we need to purchase the JPY. But here what we will do? There we have done multiplication. Here we have to do division. That I explained now. Right? So the same thing. So only we will consider selling rate only. There is no confusion. USD by INR is what? The selling rate is 75.26. USD by Japanese yen, the selling rate is what? 116.60. Got it? So we will divide these two. But one more thing. Will us consider this selling rate for the USD by Japanese? No. We will consider the buying rate. For the USD by INR, we will consider 75.26. But for USD by Japanese, we will consider 116.50. Why? I will say. Here this is selling rate. Here this is buying rate. There is a thumb rule. Just remember. Our target currency, in our earlier case, our target currency is GBP. GBP is in the numerator. And our target currency is bit currency or base currency. Then we will consider what? Selling rate. also offer rate. But here our target currency JPY, it is a quote currency, it is in the denominator side, so we will consider here buying rate. Got it? Simple. Whenever our target currency, earlier we use it for GBP by INR, or also he has given GBP by USD. There our target currency is numerator side, so we will consider selling rate. Here he has given USD by Japanese, where our target currency is in denominator side, so we will consider the buying rate. This is blind thumb rule. Got it? So what will be our answer? 75.26 by 116.50. This is nothing but around, you will get 0.6460. Got it? And he has given margin of 0.15. Margin, what we should do? Always we add it to margin. 0. plus 0.15, right? 0.15 percentage of 0.6460. It will become what? It is around 0.00969, I think, right? And so finally this will become 0.6470 in and around, right? He has given for how many Japanese yen you want? 100 millions into 100 millions. That is our answer. That is in and around 6,647,000. Right? Zeros is in 100 millions. This will be our answer. Got it? Only thing here, there they have given simple like us a 10th class mathematics. There he has given A by B, B by C. We need to A by C. Just we will do multiplication. Whenever we do multiplication, we consider the selling rate of the second currency. Second currency only. First currency no matter. First currency is a cross rate mechanism. In the first currency is always US dollars. Whenever there is a multiplication, we consider the selling rate. Whenever there is a division, we consider the buying rate. Blind thumb rule. Got it? And I think last one. See, big problem. He has given on 3rd 10 2024, your exporter customer tends export bill of US dollars 5 lakh. Okay, drawn 120 days from the date of shipment. Date of shipment is this one only, 3/10/2024. Due date is 1/2/2025. Okay, shipment bill is nothing but what? It's a mechanism of like bill of exchange. And what we need to compute? We need to compute assuming exchange margin 0.15%. Okay, spot rate he has given. Okay, premium also he has given. Direct he has given. They have not given any other amounts. Okay, amount to be round off. Okay, applicable interest rate 8.5. He has also given the post shipment export finance. He has already financing. That is also up to 180 days. Commission. Okay, what is the rate he has given? 75.14. If in the sums they has given US dollar, what rate we will consider? We consider the customer tends export bill of US dollars. Okay, customer is tending export bill. Customer tending nothing but what? Customer is having US dollars, the 5 lakhs US dollars. That is export bill. Export bill is nothing but what? Export bill is nothing but the customer is having customer is sent 5 lakhs worth of US dollars goods and services to another customer, his customer. So he has given one bill that I am going to give US dollars 5 lakh rupees. That is the bill of exchange mechanism. So he is having the bill of 5 lakhs rupees US dollars. So he is having US dollars. What he need? He wants to convert into the INR. So he is selling, the customer he is selling US dollars to the bank. So bank will consider what? Bank will consider the buying rate. Got it? So in the spot rate we will consider what? Our USD by INR is equal to 75.14. This we will consider because customer is having US dollars and he wants to into the INR. In our earlier problems, there he has mentioned the retiration of importable. There mentioned importable. Importable means what? Customer is having INR, he wants foreign currency. But here the customer is having US dollars, he wants INR. So whenever there is a purchasing, the bank is considered the buying rate. US to INR, this is the spot rate. That is one thing is fixed. And second thing is what? Premium. Right, the second thing is what? Premium. Premium is what percentage? 0.15 percentage of what? 75.14. This is in and around 0.1127. How much it is? In and around 75.0273 if we calculate it. Okay, this thing over, this thing over. Now he also said that premium directly he has given because due date is 1/2/2025, right? So that is the month end of January. So we'll consider the month end of January. Whenever we consider the buying rate, always premium also buying rate only. Whenever we consider the selling rate, premium rate also selling rate only. So we will consider premium rate, that is 0.45. The total is nothing but what? 75.4770. So this is also finished. Okay, 3 steps also finished. So this is the quote rate for the customer. Got it? How much is having? This is the USD by INR rate. How many US dollars is having? He is having 5 lakh. So into 5 lakh. What is the final answer you are going to get? That is 377,38,500. 3,77,38,500 rupees. Got it? But the bank already given some finance, that is post shipment export finance, at the rate of 8.50. How many days? 180 days. Generally post shipment export finance is given for 180 days only. So that is at what percent? 8.5. The bank already given the finance, that we should deduct it. And also the commission already 0.0625 percentage. Whenever we are going to give bill of exchange, we need to take some commission, right? That we should deduct it. So first we deduct the commission. That is easy, simple. So 0.0625 percentage of what? 377,38,500. This amount, this is commission, right? Commission amount is what? How much is this commission amount? This is, if you calculate it, in and around 23,587. In this video I am unable to show the calculator, but I am doing it manually. This is the commission amount. And interest amount is also there. Interest amount is what? 8.50 percentage for 180 days. So if we calculate, but actually this interest is for 180 days, but the customer is rendered it within 120 days only. So we consider only 120 days only interest. Got it? 8.50 per annum, but we consider only per 120 days, like a simple interest. If we consider interest rate for 120 days, what will happen? That is the interest amount in and around, if we calculate it, 10,54,610 rupees. How we will consider? I will say 3,77,38,500 into 8.5 percentage interest rate, right? In 120 days is nothing but what? Actually this is per annum. 120 days means 1 quarter, right? Into 1/4, right? 1/4. If we calculate this thing, you will get 10,54,610 rupees. And we got a commission 23,587. These two should be deducted from what? Deducted from the main amount. This is the main amount. We should deduct from minus 10 lakh 54,610 and also minus 23,587. So what is the final answer? The final answer would be 3 crore 66 lakhs 60,303. This is our final answer, right? Actually it seems very lengthy and very difficult, but nothing is there. Is having export bill. In the previous examples all the peoples is having what? Import invoice or import bills they are having, but here he is having export bill, means he is having foreign currency. See, he wants to sell to bank, so bank is consider the buying rate. This is the buying rate, and having the margin amount, that is the margin amount, that is about, see here margin amount, actually we have to less it because bank is consider the buying rate. If you less it also 75.14, this is the value, got it. And premium rate, premium for a spot, they have already given for this premium rate. For direct rate he has given that 45 by 46 paisa. We will add that premium amount. By doing all the calculation we will find that one figure. On that figure we have to minus commission amount and interest amount. Commission amount and interest amount, we will get the final amount, right? This much only, there is nothing complex. Only complex thing is what? In that numerical, the finance numericals, where to choose buying rate, where to choose selling rate. In the cross rate mechanism, when to choose buying rate, when to choose selling rate, that is the important, nothing else. Everything is a normal calculations, simple calculations only. I will told you one thing. Whenever you are using cross rate mechanism, if your target currency is a numerator, you should multiply it and you should choose selling rate. If your target currency is in denominator, you should divide it and you should choose the buying rate, that is bid rate. Okay. In the numericals, customer is having import bill, you should consider selling rate. Customer is having export bill, you should consider the buying rate. Whenever there is a buying rate, you should minus the margin. Whenever there is a selling rate, you should add the margin. Bus. This much only. There is nothing more complex. Got it? If you consider this video is helpful, kindly share to maximum peoples and also subscribe to my channel FinBank Academy. Got it? Thank you and all.